The undo button. How to reverse a Roth IRA mistake legally. This is what the IRS still allows you to reverse when it comes to Roth IRA contributions, what it permanently eliminated starting in 2018, and how recharacterization works as a legal correction tool for specific contribution mistakes. There used to be a full undo button for Roth IRAs. Before 2018, if you converted money from a traditional IRA to a Roth IRA and then changed your mind, whether because the market dropped and you owed taxes on a higher value than what was left, or because you realized the conversion created tax problems you had not planned for, you could reverse it. The process was called recharacterization of a conversion, and it allowed you to move the money back from the Roth IRA to a traditional IRA by October 15th of the year following the conversion. The Tax Cuts and Jobs Act of 2017 eliminated that option permanently. Starting with the 2018 tax year, Roth conversions cannot be reversed. Once money moves from a traditional IRA or a 401k into a Roth IRA through a conversion, it stays there. There is no unwinding it, no changing your mind, no recovery if the market drops and you paid taxes on a value that no longer exists in the account. That particular undo button is gone. What remains available is recharacterization of contributions, which is a different transaction entirely, and it is still fully legal and permitted by the IRS. A contribution recharacterization allows you to change the designation of a regular annual IRA contribution from one type of IRA to another. A Roth IRA contribution can be recharacterized to a traditional IRA contribution, and a traditional IRA contribution can be recharacterized to a Roth IRA contribution. The deadline is October 15th of the year following the tax year for which the contribution was made. For a 2025 contribution, the recharacterization deadline is October 15th, 2026. This extended deadline is available if you filed your tax return by April 15th, 2026, or obtained an extension. The recharacterization must be done as a direct trustee-to-trustee transfer. The money moves from one IRA to the other without passing through your hands. Any earnings or losses on the contribution since the original contribution date follow the money to the new account. Two situations make contribution recharacterization most useful. The first is earning more than expected. Roth IRA contributions phase out above certain income thresholds. Someone who contributed the full Roth IRA amount early in the year, then received a bonus, a raise, or unexpected income that pushed their modified adjusted gross income above the phase-out range, ends the year with an excess Roth IRA contribution. Recharacterizing that contribution to a traditional IRA converts it from a prohibited excess contribution to a legitimate traditional IRA contribution, eliminating the 6% excise penalty. The second is the reverse scenario, contributing to a traditional IRA and later discovering you were eligible for a Roth contribution instead. If your income was lower than expected and the income limits allowed direct Roth contributions, you can recharacterize the traditional IRA contribution to a Roth IRA contribution and capture the tax-free growth benefits. There is a distinction worth making between recharacterization and reconversion. Before 2018, the process involved converting to a Roth, then recharacterizing back to a traditional IRA, and then converting again. That chain no longer works because the first recharacterization of a conversion is now prohibited. What remains is the single-step contribution recharacterization, which applies only to annual contributions made directly to an IRA, not to conversion amounts. If you contributed to a Roth IRA in 2025 and your income came in above the limits, you have until October 15th, 2026 to recharacterize that contribution to a non-deductible traditional IRA. The excess is resolved, the 6% penalty is avoided, and the contribution counts for the prior tax year in its new form. The recharacterization must be reported on your tax return. The IRA custodian will generate a Form 1099-R for the distribution from the original account, and you report the transaction using Form 8606 as needed. The undo button for Roth conversions is gone and will not return barring new legislation. The correction tool for contribution mistakes is still available through October 15th of the following year, and it functions exactly as it always did. Understanding which type of transaction you made, a conversion or a contribution, determines whether a correction is possible at all. The part that makes the undo button, how to reverse a Roth IRA mistake legally so important, is that the headline usually sounds simpler than the reality. A retirement account rule can look like a clean yes or no decision from the outside, but inside the account there are layers. Who owns the asset? Where the money came from? How the IRS classifies the transaction? And whether the paperwork matches the economic reality. The people who get hurt are usually not trying to cheat the system. They are usually assuming that a familiar personal finance rule works the same way inside a tax-advantaged account, and that assumption is where the danger begins. A useful way to understand the undo button, how to reverse a Roth IRA mistake legally, is to separate opportunity from control. The opportunity is the tax advantage, the legal structure, or the extra flexibility the rule creates. The control is what you must give up to keep that advantage intact. Inside retirement accounts, you often gain tax treatment by accepting restrictions on access, timing, ownership, documentation, or personal benefit. When someone focuses only on the upside and ignores the restrictions, the strategy stops being a tool and becomes a trap. The first practical question is always ownership. Who legally owns the money, the asset, the account, or the benefit at the exact moment the transaction happens? In normal life, people think in practical terms. I paid for it, I manage it, therefore it is mine. The retirement account world is different. The account can be the legal owner even when you are the person making decisions. That distinction matters because a tax break is often attached to the account, not to you personally. If the ownership line gets blurred, the IRS can treat the transaction as if the tax shelter was broken. The second practical question is timing. Many tax rules are not just about what you do, but when you do it. A transaction that is harmless in one year can be expensive in another. A withdrawal that is clean after a waiting period can be taxable before the waiting period ends. A conversion, contribution, distribution, sale, rollover, or account transfer can all create different outcomes depending on the calendar. This is why dates, tax years, account opening years, and transaction records matter more than most people expect. The third practical question is money flow. Every dollar should have a clean path. Where did it start? Where did it go? And what account touched it along the way? Problems appear when personal money and retirement money cross paths without a clear reason. Problems also appear when income that belongs inside an account is deposited personally, or when an expense that belongs to the account is paid out of pocket, even when the dollar amount is small. The pattern can signal that the account and the owner are not being treated as separate financial entities. Documentation is not decoration in these strategies. It is the evidence that the transaction happened the way the strategy requires. Statements, custodial forms, plan documents, tax forms, written approvals, purchase agreements, beneficiary records, conversion confirmations, and distribution records are the paper trail that turns a story into proof. If the records are missing or inconsistent, the taxpayer may still believe they followed the rule, but proving it later becomes much harder. In a dispute, memory is weak. Documents are stronger. Consider two investors looking at the undo button, how to reverse a Roth IRA mistake legally. The first investor asks only one question: how much money can this save me? The second investor asks a different set of questions. What rule creates the benefit? What would disqualify it? What records prove compliance? And what happens if my situation changes? The first investor may move faster, but the second investor is less likely to create an expensive surprise. Most sophisticated financial planning is not about finding the flashiest move. It is about knowing which details keep the move from backfiring. The emotional trap is urgency. People often hear about a loophole, deadline, exception, account feature, or tax advantage and feel as if they need to act immediately before the chance disappears. Urgency is useful when it motivates research, but dangerous when it replaces research. The right response is to slow the decision down just enough to map the rule. What is allowed? What is prohibited? What is uncertain? What professional should review it? A strategy that cannot survive careful questions is not a strategy worth rushing into. Another overlooked risk is assuming that a platform, custodian, employer, broker, or online form will stop you from making a mistake. Financial institutions are often responsible for processing instructions, not for guaranteeing that the instruction is optimal for your taxes. A button may allow a transfer, a custodian may process a distribution, a plan may permit a contribution. That does not automatically mean the tax result is the one you wanted. The taxpayer is usually the person left explaining the transaction when tax season arrives. The cleanest way to approach the undo button, how to reverse a Roth IRA mistake, legally is to build a checklist before money moves. Identify the account involved. Identify the rule being used. Identify the tax form that may be created. Identify the deadline or holding period. Identify who is allowed to benefit. Identify what would make the transaction taxable or penalized. Then decide whether the potential benefit is large enough to justify the complexity. This kind of checklist does not make the strategy exciting, but it makes it usable. There is also a difference between legal and practical. Something can be permitted by the tax code and still be a poor fit for a person who does not want administrative complexity. Something can be available inside a retirement account and still be inappropriate if it creates liquidity problems, record-keeping problems, or concentration risk. The best strategy is not the one with the most impressive headline. The best strategy is the one a person can execute correctly, maintain consistently, and explain clearly if anyone asks. The deeper lesson behind the undo button, how to reverse a Roth IRA mistake legally, is that tax-free or tax advantage does not mean rule-free. It means the government is offering a benefit in exchange for staying inside a defined structure. The benefit can be powerful, but the structure is not optional. Once you understand that, the entire subject becomes less mysterious. You stop asking, can I get away with this? You start asking, what exact conditions make this work, and can I meet them without creating a new problem? Before making a move, the safest habit is to write down the intended result in plain English. Then compare that intention with the mechanics. If the goal is tax-free growth, does the money actually remain inside the account? If the goal is avoiding a penalty, has the relevant clock actually finished? If the goal is protecting an asset, is the title or beneficiary record correct? If the goal is using a deduction or credit, do the income limits and documentation support it? Clear intention plus clean mechanics is where good planning lives. The final point is that mistakes are often easier to prevent than to repair. Some errors can be corrected with forms, recharacterizations, amended returns, return contributions, or careful timing. Others are much harder because the transaction has already happened and the tax treatment is locked in. That is why the best time to understand the rule is before the account is touched, before the asset is purchased, before the distribution is requested, and before the tax form arrives. In retirement planning, the cheapest correction is the one you never need. So when you hear about the undo button, how to reverse a Roth IRA mistake legally, do not treat it as a shortcut. Treat it as a structured financial move. The upside may be real, but the details are the price of admission. Know who owns the money, know which clock is running, know where the dollars flow, know what documents prove the transaction, and know which line you cannot cross. That is how a powerful tax strategy stays powerful, instead of turning into the exact bill it was supposed to avoid.